so much for taking time out of your day to join me for another educational moment. Please remember that the information presented in these videos are not meant to be legal, professional, or tax advice. They are strictly for educational purposes. In case you missed my previous videos, my name is Sharon Grimes. I am a seasoned accountant with over 25 years experience working in various managerial accounting roles for corporations ranging in sizes from small mom and shop to international manufacturing corporations with roughly 500 employees and a little over $100 million in annual worldwide revenue. I am also an enrolled agent, which is a designation given by the IRS to individuals who have proven that they have enough tax knowledge to adequately represent someone before the IRS. This designation requires a certain amount of IRS-approved continuing education, which is how I became involved in the cannabis industry and its unique accounting and tax issues. If you're not familiar with them, I would advise watching my first video, which can be found on my YouTube channel, Sharon Grimes Accounting. If you have seen my previous videos, welcome back, and thank you so much for joining me again. It is truly an honor. In this episode, I will briefly discuss the chart of accounts, balance sheet, income statement, and then the accounting formula. So let's talk about the chart of accounts. This is a systematic set of accounts that summarizes all the transactions that take place in your organization. I cannot stress how important the development of the chart of accounts is. This is the heart of tracking your financial data. The chart of accounts is always organized in the manner demonstrated on your screen with major categories broken down into smaller categories. The first category in the list is assets, followed by liabilities. Notice how both assets and liabilities have subcategories of current and non-current, and then there will be more subcategorization between them as you go on. Then comes owner's equity. Owner's equity consists of all funds that an owner has put into the business, as well as the cumulative net income or loss of the business year over year. These first three categories make up your balance sheet. The next two categories consist of your income statement accounts, revenues and expenses. Revenue accounts typically consist of revenue, discounts, and returns and allowances. Expenses will be segregated in a manner that best suits your company. But the basic subcategorization is cost of goods sold, sales and marketing, and general and administrative. In cannabis, the subcategorization of cost of goods sold, sales, marketing, and general and administrative will be very important because, as you may recall from my prior video, in the THC world, the only expenses your company will be entitled to when calculating taxable income is the cost of goods sold. So it will be essential to track what is and isn't eligible for cost of goods sold. Here is an example of a chart of accounts. Your chart of accounts can be designed numerically, alphabetically, or a combination of the two. In this example, they use numerical and only 3 digits. For a small service company, 3 digits may be enough. However, I always recommend a 4 or 5-digit number. It allows room for growth, but is still small enough to be easily remembered. Take note of the flow of this chart of accounts. All the assets begin with the number 1. The current assets begin with 1-1. However, when you get to land, which is not a current asset, notice how it is 1-2. So their system is all current assets begin with 1-1 and non-current assets begin with 1-2. Sometimes companies will use 1-1 for cash, 1-2 for cash equivalents, 1-3 for accounts receivable, 1-4 for inventory, 1-5 for fixed assets, and so on. This is a type of pattern that I highly recommend, and it's logical, but it'll also depend on the structure of your business. Liabilities begin with 2. And again, you can have a further categorization where notes payable and credit cards begin with 2-1, current portion of notes payable begin with 2-2, salaries payable begin with 2-3, and so on. Going down the equity piece, all those equity accounts begin with the number 3. And then you can also have a further subcategorization where capital stock is 3-1, retained earnings 3-2, dividends 3-3, and income summary 3-5. In this particular example, they choose to keep everything at 3-1. It just depends on how you want to build your chart of accounts. In revenues, you see that there are 3 accounts: sales, returns and allowances, and sales discount. They keep everything at 4.1, but another option would be sales at 4.1, returns and allowances at 4.2, sales discounts at 4.3. And again, it's based on how you want to design your chart of accounts. Every business is different. And then you go down to expenses and you can see there's another breakdown of the expenses. While you can use an alpha system, I always recommend numerical because it is much easier to remember numbers than words. And I'll use supplies as an example. Let's say you buy pens and paper. Pens and paper can fall into office supplies, other supplies, miscellaneous supplies, etc. It all depends on who your bookkeeper is and the process he or she chooses to use. And with that, your chart of accounts can grow into this monstrous mess that becomes almost impossible to analyze year over year. However, when you use an organized numeric system, it reduces the possibility of that confusion. I also recommend trying to keep your chart of accounts small. There are some experts that say it shouldn't be longer than 50 accounts long. Sometimes that is not possible, but if you do feel the need to create a new account, I always recommend asking, why is the new account necessary? What is it that I am trying to track? Is there another way to track this information? I once worked for an organization where their chart of accounts was roughly 5,000 accounts. The problem was, every time someone wanted to track a new piece of information, the very first thought was, oh, well, just create a new chart of account number. And that was how that company's chart of accounts got out of control. Instead, they should have been asking, why do we want to track this information? Is there another way? And they should have contacted their software provider to talk to them about tracking the information in a new way. In the end, that was what we ended up doing, and we significantly reduced the number of accounts that they had. Another example was a company that I worked with. They had a bunch of loan payables to their owners. These loan accounts are scattered all over the place with many different names, from owner's loan, loan from owner, or the owner's name with a dash and loan payable. For example, so Scott dash loan payable. This made it very difficult to see how much money the company actually owed back to the owners. In this particular case, the primary manager thought the company only owed the owners $15,000. However, once all those loans were organized into a consistent manner under the same grouping, it became apparent that the amount owed to the owners was closer to $150,000. So again, numbers tend to increase consistency and decrease confusion. Your chart of accounts should be specific to your business. All chart of accounts follow the same basic principles, but every business is different and has different reporting needs. So your chart of accounts should be specific to your business. I always recommend creating it in Excel first, where you can easily group things, edit it, change it, modify it. And then once you feel like it's complete, then you can import it into your accounting system. So let's talk assets. So you'll see here, you have current assets, which are cash, cash equivalents, accounts receivable, inventory, prepaid expenses. And this is not an exhaustive list of current assets. These are just examples. What are cash equivalents? Cash equivalents are usually CDs or mutual funds. In accounting, the basic principle is anything longer than 1 year does not fall into current. So that goes with assets and liabilities. Non-current assets include fixed assets such as machinery and equipment, vehicles, buildings, land. The general rule for fixed assets is that if the purchase is above a certain dollar amount and the item will last longer than 1 year, it probably should be capitalized into a long-term asset. That's not always the rule, and the dollar amount will vary depending on your business. For some businesses, it might be $1,000. Others, it might be $5,000. Companies like Boeing, where they're creating airplanes and have numerous amounts of assets, the threshold might be closer to $10,000 or even $20,000. It really depends on the size of your business and what is standard in the industry. Other non-current assets include intangible assets such as trademarks, copyrights, and patents. And then there's also long-term investments. So that would be investments that you intend to keep for longer than 1 year. So now we go over to liabilities. Again, current liabilities, long-term liabilities. Your current liabilities is anything that you're going to be paying within 1 year. Your accounts payable, which are bills that you have coming due, such as electric, rent, phone, suppliers, etc. Then there's your credit cards payable. They are generally due within a year. Your current portion of notes payable. Notes payable are usually loans that you take out when you purchase equipment. Instead of calling it loans payable, we call it notes payable. And whatever portion of that note that is due within the upcoming year is considered your current portion of notes payable. And then deferred revenue. The best example of deferred revenue is way back when we used to purchase magazines and you would pay for a full year subscription. So if you were the magazine owner, somebody paid you for a 1 year subscription, you didn't earn that money right up front. Each month as you issued the next magazine, then you earn the money. So when you receive the money up front, that's called deferred revenue. And then as you earn it, you recognize it into revenue. And then you have your long-term liabilities, your notes payable, bonds payable. Bonds payable are usually when you're raising capital and instead of selling stock, you sell a bond. It's a loan. Capital leases, and these are leases that are for what otherwise would be considered a purchase. There's a lot of rules to that and beyond the scope of this. Owner's equity. So your basic parts of owner's equity is contributed capital, distributions, dividends, and retained earnings. Your contributed capital, so paid in capital. That is the money that an owner put into the company right in the very beginning. If in later years they have to add additional money, it becomes additional paid in capital. Or another alternative is to loan the company money. It all depends on what the owners want to do and how they want to categorize it. There's tax issues related to your decision, so always talk with your tax professional when making that decision. And then stock. If you sell stock, the stock gets listed under contributed capital. Then you have distributions, dividends. For a C Corp, distributions of your income are called dividends. For everything else, it's just called a distribution, and it gets recorded in your balance sheet as such. And then retained earnings, which is, as I stated earlier, your cumulative net income year over year. This is your basic income statement. You have your sales less your returns and allowances, which then gives you net sales. So net sales are different than net income. Then you go down to your expenses. You have your cost of goods sold, which then gives you your gross profit. So net sales less cost of goods sold is gross profit. Gross profit can sometimes also be known as the contribution margin, depending on the way you report your information. And your contribution margin is basically telling you how much revenue you have left after covering variable expenses to pay for other expenses in order to generate a profit. Gross profit is also where companies that are subject to 280E, the cannabis industry, THC in particular, are taxed. So remember, gross profit is your taxable income in the THC world. Everything else that falls below that line is a non-deductible expense when calculating taxable income. So let's talk about the accounting formula. I wonder how many of you out there, when you were in junior high math class and saw algebra and struggled with it, were like, when am I ever going to use this information? Well, here you go. Here's basic algebra coming back at you. And I hope some of you remembered it. In case you didn't, the basic formula for accounting is assets equals liabilities plus owner's equity. If you remember back to your algebra class, anything that happens on one side of the equal sign must also happen to the other side of the equal sign in order to keep that statement true. So let me give you an example of what I mean. So let's say you have assets of $12,500, liabilities of $7,250. That means that your equity, or what you put into the company, is $5,250. So if you look at the equation, right, $12,500 equals 7,250 plus 5,250. This statement right now is true. Now let's say you purchase a piece of equipment for $8,000. So you add $8,000 on to the asset side for the equipment. But if you don't do something to the other side, this statement is no longer true, is it? You have to add $8,000 on here. So is it a liability, or did it come from owner's equity? Did the owner take the money out of their own pocket and purchase the asset and give it to the company? Another option is that you add the $8,000 to the asset for the equipment, but then let's say the company paid cash for this asset. Then you would minus another asset. So you have plus 8,000 minus 8,000 on the same side of the equal sign, which means that this statement is still true. In a nutshell, that is how the accounting works. So whatever happens on one side of the equation has to happen to the other. So let's look at a few more examples to really try to solidify this concept. You open a bank account with cash. So the accounts that are going to be affected is either cash, well, it is going to be cash on the one side of the equal side. And then on the other side, it's either going to be equity or liability. So either it's contributed capital from the owner, or a loan was issued and that's how you got the cash. And so therefore you would have a liability. Another transaction, you pay for website development. Well, one side of the transaction is cash. You're going to decrease your cash. And then on the other side is an expense. And if you remember, your expense goes into your income statement. Your income statement flows into your retained earnings, which is a part of your owner's equity. So it all flows up. It hits both sides of the equation. Let's say you get a loan to purchase equipment. The accounts that are going to be affected here is notes payable and machinery and the equipment. So as you can see, there's always two accounts that are going to be affected in any transaction that happens in your business. I'm going to leave you off with that, as I feel like that's a lot of information to try to consume all at once. And I will see you the next time. Thank you so much for joining me. And as always, I would love to hear your feedback. Thanks. Have a great day.